2000% silver revaluation is here? Every stacker needs to watch this now. What if I told you that the most undervalued asset on the planet right now isn't Bitcoin, it isn't gold, it isn't real estate, it's sitting in a drawer, in a coin, in a bar, in an industrial warehouse somewhere in Shanghai, and the people who understand what's happening to it right now could be witnessing the setup for one of the most explosive monetary events in modern financial history. I'm talking about silver. And no, this is not another silver to the moon video. This is a macroeconomic briefing, a cold, hard look at the numbers, the institutions, the geopolitical forces, and the structural mechanics that are quietly, and I mean quietly, converging on this single metal in a way that hasn't happened in decades. Stay with me, because by the end of this video, you will never look at silver the same way again. Here's what most investors completely miss. They look at silver and they see a commodity, a shiny metal, something their grandfather maybe kept in a safe. What they don't see is the architecture underneath, the monetary history, the supply mechanics, the industrial transformation, the central bank behavior, the dollar dynamics, the quiet institutional accumulation happening right now while retail investors are distracted by headlines. Most people think silver moves because of speculation, because stackers buy coins, because Reddit forums get excited. That is not what moves silver in a structural, lasting, generational way. What moves silver, really moves it, is when monetary pressure collides with physical scarcity at the same moment that industrial demand explodes. And right now, in June 2026, all three of those forces are aligning simultaneously. By the end of this video, you're going to understand exactly why that matters. You're going to understand the historical precedent, you're going to understand the supply deficit that Wall Street is barely talking about, and you're going to understand what a 2000% revaluation would actually mean, where that number comes from, and whether the math even remotely supports it. Let's begin. Section 1. The monetary foundation. To understand what's happening to silver today, you have to go back. Not a few years, decades. Nixon closes the gold window. The United States officially severs the dollar's connection to physical metal. For the first time in modern history, the world's reserve currency is backed by nothing but confidence, by faith, by the full faith and credit of a government that, spoiler alert, has now accumulated over $36 trillion in debt. That decision in 1971 set in motion a slow-burning monetary experiment that the world has never fully reckoned with. Here's what happened next. Without the anchor of metal, central banks gained something they never had before: unlimited printing capacity. The ability to create money from nothing, to inflate away debt, to fund wars, bailouts, stimulus packages, and political promises without ever having to balance the books. And for a while, it worked. Globalization kept prices low. Technology kept productivity high. The dollar stayed dominant because what was the alternative? But systems built on confidence have a fatal flaw. Confidence can break. And when it breaks fast. Now think about where we are right now. The Federal Reserve has spent the last several years in one of the most aggressive rate hiking cycles in history, trying to kill the inflation monster it helped create. The US national debt has crossed $36 trillion and is accelerating. Global central banks, China, Russia, India, Turkey, Poland, have been buying gold at a pace not seen since the 1960s. De-Dollarization is no longer a fringe theory. It is a documented, measurable geopolitical trend. And silver? Silver is sitting right at the intersection of all of it. Section 2. The gold-silver ratio. Let me give you one number. Right now, the gold-silver ratio is sitting near 90 to 1. That means it takes roughly 90 ounces of silver to buy 1 ounce of gold. Now here's what that number means historically. For most of recorded monetary history, the ratio hovered between 15 and 20 to 1. The Roman Empire legally fixed it at 12 to 1. The US Coinage Act of 1792 set it at 15 to 1. Even in the modern era, the ratio has averaged closer to 50 to 1 over the past several decades. At 90 to 1, silver is historically cheap relative to gold by almost any long-term standard. Now, here's where it gets interesting. When the gold-silver ratio is this elevated, and then it begins to compress, meaning silver starts catching up to gold, the move in silver percentage terms is enormous. It has to be. Because silver is starting from a much lower price, it has to move much faster to close the gap. In 1979 and 1980, when the ratio compressed from above 40 to nearly 17, silver went from around $5 to nearly $50 an ounce, a roughly 900% move in under 2 years. In 2011, during the post-financial crisis commodity surge, silver ran from approximately $8 to nearly $50 again, a move of over 500% in just a few years. Now, I'm not here to predict those exact numbers. Markets are complex. Timing is uncertain. Anyone who tells you silver is going to $500 next month is not a macroeconomic analyst. They're selling something. But here's the honest question every investor needs to sit with. If the monetary pressures building right now are larger than 2008, and by most measurable metrics, they are, and if silver's starting point is this historically undervalued relative to gold, then what does the math begin to point toward? That is not a prediction. That is a framework. And frameworks matter more than predictions. Section 3. The supply deficit nobody is talking about. Now here's where this story gets truly alarming. Because most silver investors focus on the monetary argument, the inflation hedge, the dollar debasement play, the gold-silver ratio. And all of that is valid, but it's only half the picture. The other half? Physical supply. For the past several consecutive years, the silver market has run a structural supply deficit, meaning the world is consuming more silver than it is mining. The Silver Institute, which tracks global supply and demand data, has documented this deficit growing year after year. In 2023 alone, the deficit exceeded 140 million ounces. In 2024, the numbers pointed toward an even deeper imbalance. Now think about what that means. Every single year that demand exceeds supply, someone is drawing down the existing stockpile. The above-ground silver inventory is shrinking, not dramatically in the short term, but structurally, consistently, and in a direction that has only one long-term outcome. And here's the part that most retail investors don't fully appreciate. Silver is not like gold. Gold is hoarded. Almost every ounce of gold ever mined still exists in some form. A central bank vault, a piece of jewelry, a coin. It gets recycled. It gets reused. Silver gets consumed. When silver goes into a solar panel, it's gone. When it goes into a semiconductor, it's gone. When it goes into an electric vehicle battery management system, it's gone. When it goes into medical equipment, military electronics, water purification systems, it's gone. And here's the acceleration factor that should make every investor pay very close attention. The green energy transition. Right now, the global economy is undergoing the largest energy infrastructure transformation since the Industrial Revolution. Solar panels are being deployed at a scale that would have seemed science fiction 10 years ago. And every single solar panel requires silver. Silver paste is used in photovoltaic cells to conduct electricity. There is currently no commercially viable substitute. The International Energy Agency projects that solar capacity needs to triple or quadruple over the next decade to meet global climate targets. Each gigawatt of solar capacity requires millions of ounces of silver. And then add artificial intelligence. AI data centers require enormous amounts of advanced electronics. Advanced electronics require silver. The build-out of AI infrastructure, the physical material build-out, is a silver demand story that almost nobody in the financial media is connecting. So you have a structural mining deficit, a shrinking above-ground stockpile, an exploding industrial demand from two of the most powerful macro trends of the decade, green energy and AI, and a monetary environment where the dollar is under pressure and precious metals are seeing renewed institutional interest. Tell me again why silver is undervalued. Section 4. The COMEX mechanics and paper silver. Now I need to talk about something that makes sophisticated silver investors very uncomfortable. And it should make you uncomfortable too. The price of silver right now is not set by physical supply and demand alone. It is primarily set by the COMEX, the commodity exchange in New York, where silver is traded in futures contracts, paper contracts, promises to deliver silver at a future date. And here is the critical fact. The amount of silver traded on the COMEX on any given day vastly exceeds the amount of physical silver that actually exists in COMEX warehouses. At various points in recent years, Analysts have calculated that there are dozens, sometimes hundreds, of paper ounces traded for every single physical ounce in the warehouse. Now, why does that matter? Because when there's that much paper silver floating around relative to physical silver, it suppresses the price. It creates artificial supply. If I can sell you a promise of silver rather than actual silver, I can effectively create silver out of thin air, just like central banks create currency. But here's what changes the game: physical delivery demands. When major buyers, institutions, sovereign entities, industrial consumers, start demanding physical delivery rather than cash settlement on their futures contracts, the leverage breaks down. The paper promise has to become a physical bar. And if there isn't enough physical silver to meet those demands, the price discovery mechanism resets violently. We saw a preview of this dynamic in early 2021 during the Reddit-driven silver squeeze. The COMEX registered silver inventory dropped sharply. Premiums on physical coins and bars surged. For a brief moment, the paper price and the physical price began to diverge. That divergence never fully resolved. It just went quiet. But the structural tension, the gap between paper claims and physical reality, didn't disappear. It has continued to build. If you want to understand why some institutional analysts use words like revaluation rather than simply price increase, this is why. A revaluation implies a reset of the underlying price discovery mechanism itself, not just market sentiment shifting. Section 5. The macro backdrop. Fed policy, dollar, and debt. Let's zoom out one more time, because the monetary backdrop matters enormously. The Federal Reserve is in a historically impossible position. It raised rates aggressively to fight inflation. But those higher rates are now crushing the federal government's interest payments. The US is now spending more on interest on its debt than it spends on defense. That is not a fringe talking point. That is in the official budget data. The math only works in one direction from here. Eventually, not tomorrow, not next month, but structurally, inevitably, rates have to come down. Debt has to be managed. The currency has to absorb the excess. That is currency debasement. And currency debasement is historically the most powerful tailwind precious metals have ever had. Now add the geopolitical layer. BRICS nations, Brazil, Russia, India, China, South Africa, and their growing list of partners are actively working to reduce their dependence on the dollar-denominated financial system. They are settling trade in local currencies. They are accumulating gold reserves. They are building alternative payment infrastructure. This isn't conspiracy. This is documented central bank behavior. Published, reported, measurable. And every percentage point of global trade that moves away from dollar denomination is a percentage point of pressure removed from the dollar's artificial support, which means real purchasing power loss for dollar holders, which means real gains for dollar alternative assets, gold, silver, hard assets. Now, here's the final piece of the puzzle that ties everything together. Silver historically moves after gold. Gold breaks out first. It's the larger, more liquid market, the institutional safe haven. But when gold has moved substantially and the gold-silver ratio remains elevated, silver tends to close that gap explosively. Gold has been making historic highs throughout 2024 and into 2025. The ratio has remained stubbornly elevated. That gap doesn't stay open forever. Section 6. Where does 2,000% come from? Let's address the number in the title directly, because intellectual honesty matters. 2,000% silver revaluation. Where does that number come from? Is it real? Is it clickbait? Or is it somewhere in between? Here's the honest framework. If you believe, and there is credible academic and institutional research supporting this, that silver's current price reflects decades of paper market suppression, structural undervaluation relative to gold, and a monetary system that hasn't fully priced in dollar debasement risk, then you can construct a model where silver's fair value, under conditions of monetary reset or significant dollar confidence loss, could be multiples of its current price. Let me give you the math simply. Silver today trades around $30 to $35 an ounce. Gold trades at roughly $3,000 to $3,300. If the gold-silver ratio simply returned to its historical average of 16:1 and gold stayed where it is today, silver would be priced between $187 and $206 an ounce. That's already a 500% move from current levels. If gold continues its upward trajectory, driven by dollar weakness, de-dollarization, and central bank buying, to say $5,000 an ounce, and the ratio normalizes toward 15:1, you're looking at silver near $333 an ounce. That is a roughly 1,000% move from today. Now extend the scenario. If you model a genuine dollar confidence crisis, not a crash, not hyperinflation, but a sustained loss of confidence in U.S. fiscal management, gold could move toward the numbers that serious macro analysts like Luke Groman, Lynn Alden, and others have modeled. 5,000, 8,000, higher in extreme scenarios. At a normalized gold-silver ratio in those scenarios, silver's implied price begins entering territory that, from today's price, represents that 2,000% range. Is that guaranteed? Absolutely not. Is it possible under conditions that are historically precedented and structurally building? The math says yes. That's not hype. That's a scenario framework, a conditional prediction. If these conditions continue and these historical relationships reassert themselves, this is the direction the math points. So here's where we land. Silver sits at one of the most unusual confluences in modern financial history. A structural physical supply deficit that is deepening year after year. Explosive industrial demand from solar, AI, and green infrastructure that has no near-term substitute. A paper market that may be significantly misrepresenting true physical scarcity. A gold-silver ratio at historically elevated levels that has always eventually compressed. A macro backdrop of dollar pressure, debt crisis mechanics, Fed policy constraints, and de-dollarization that is the most bullish environment for precious metals in a generation. None of this means silver goes up tomorrow. Markets are irrational. Timing is brutal. The paper market can suppress price for longer than any of us want to believe. But here's the question I want to leave you with. When was the last time you saw a hard asset with this much structural demand pressure, this much monetary tailwind, this much documented physical scarcity, and this much historical precedent for explosive price moves, trading at a price this low relative to everything around it? Because I'm struggling to find another example. The window of maximum opportunity, if this thesis is correct, is not when silver is at $100 and everyone is talking about it. It is right now, when the narrative is still forming, when most investors are still looking elsewhere, when the crowd hasn't arrived yet. Smart money doesn't chase the move, it positions before the move and waits. The question isn't whether silver will eventually reflect its true value in a world of monetary pressure and physical scarcity. The question is whether you'll be holding it when it does. Think about that, and if this analysis gave you a new way of looking at the silver market, if it connected dots you hadn't connected before, then make sure you're subscribed, because the next video goes deeper into what a genuine monetary reset would actually look like, into which forms of silver exposure make sense for different investors, and into the one signal I'm watching more closely than any other right now that will tell us whether this move is beginning. You don't want to miss that one. I'll see you there.